Hello. What you're looking at is the TexasVestments.com About Us page. We are an investment club based here in Dallas, Texas. I'm the club president, Lee Ennis. The healthcare sector. This one is interesting because we're currently in Pfizer, PFE, but it is a legacy stock. So it's a very small position. We really can't sell. We can purchase more shares, but we don't have a buy signal. We can't get the price down low enough to do so. So we have the option of basically sending this position into our orphan bin. Okay, and what that simply means is that it'll be stock that we own, we collect dividends for, but we don't sell, we don't add to it. With that being said, it's possible that the dividends we collect over the years can more than cover the cost of selling the position. We would need to hold this position for about 25 years, and it would have doubled. Right, we have $100 worth of dividends on $100 stock, basically. Okay, so that is an option for us. So we'll be looking at either adding to Pfizer, okay, maybe at a higher price than what we want, but we either add to Pfizer or simply buy one of these companies here. So let's take a quick look. Looks like the dividend, let's see how close they are. Oh yeah, it's a big difference. So it's about a 1 point difference between BNY and DGX. Let's take a look here. Looks like neither one of these companies have performed very well. Both have negative returns over the last 18 months. Looks like BNY is a bit cheaper than the rest. DGX maybe a bit expensive here. Let's take a look and see kind of where we are on our averages. So BNY is under its average, DGX is above its average. Being that DGX is negative for the year and it's above its average, tells me that it's probably overpriced, overvalued. But we'll want to take a look at the financials to prove that, to make sure of that, right? Net profit, bottom line, looks good for both BNY and Pfizer. DGX is a different company, so we can't really compare those. But decent profit margin for sure. Return on assets about the same across the board. Looks like BNY has a whole bunch of cash on deck, and crazy enough, it looks like they have more cash than debt, which is why we have a 1.14 number here. So that's interesting. I definitely want to take a look at that and find out what's going on there. Being that Pfizer and DGX have about the same amount of cash, it is surprising that the cash to debt ratio is much higher for Pfizer, which means that DGX may have a lot of debt on the books. BNY has a lot of short interest, more than what I've seen so far in the other sectors. So that definitely gives me pause that there's a lot of people looking for this stock to fall, and there may be a reason for that. Looks like DGX is very close to its highs, way off of its lows, but Pfizer and BNY are about the same place, I would say. So again, it's price action has not been great for DGX, um, but clearly it's close to its 1 year high. So that's a good thing. So we want to look at that a little closer and just see really what's going on. Alpha is about the same. Wow, yeah. Look at Pfizer's up move. It's horrible. But the down move is good though. So that's interesting. And about the same for BNY DGX. Beta's about the same. Return the same. Volatility. And it looks like we have this. Yeah. So DGX has just a smaller, edge over BMY, but they're about the same. Pfizer's a little further down on that list, and again, the M score is going to be much higher for BMY, again, just because of the cash on hand. So again, we'll want to find out what the cash is there for, what they're doing with it. We definitely want to look into the valuation for DGX to understand why the valuation is as high as it is, why it's close to its 1 year high, but still a negative return. And there's also a story that Pfizer is going to spin off, or basically get rid of their over-the-counter section of their business. And so there's a lot of questions around what happens if they do that, because if they get rid of the over-the-counter part of their business, then Pfizer is just a biochemical company that's researching and coming up with new medicines. They don't have that steady cash flow of people buying Advil or whatever it is that they sell. And so what does that do to the dividend? Is it going to stay the same? Are they going to cut it? Are they going to move the dividend with the new company that's being spun off? We don't know yet. So that's something that we'll have to look at as well. Looking at our industrial sector, we got waste management, which is where we are now, which, as you can see from the price action, has done really well over the last 18 months. IEP, not so much. But it's interesting, though, looking at this, 12% dividend means that the dividend has more than made up for the price decrease. So that's really interesting. Typically the dividend doesn't play that large of a role, but in this case, it plays a huge part in the actual price action. Because if you add the dividend to the current price, then it actually had a positive gain over the last 18 months. So we'll really look at that price action and find out what's going on there. I mean, 12% is really hard to ignore. Right, let's take a look here. All right, so of course, PE much lower for IEP, and we have much lower than average, and both of these are under the average, but IEP much lower. And here's why we have the problem with the price action. Net profit, operating profit, negative. So they're losing money, but they're still paying a 12% dividend. There's a very good chance that dividend will be cut, but we'll need to look further into that I was just reading that their payout ratio is roughly 60%. So 60% of their cash flow is being spent on the dividend, which means that they can continue doing that for some time. So, you know, we'll have to find out why they're losing money, what they're doing about it, and maybe it'll make sense to get into it. All right, return on assets. Of course, you know, waste management doing much better. Lots of cash on hand for IEP, and cash debt ratio. Again, that's about right with the amount of cash that's there. Short interest about the same. As far as price action goes, I would say that these companies are about the same. Of course, you know, waste management has you know, done really well. IEP not so much, but it's not far off its highs. Really not. You know, roughly 15% versus 5%. Alphas are about the same. Of course, the up move for IEP is much better. Betas are about the same. Waste management has a better average return monthly. IEP, much more volatility. And of course, they score higher for the management score as well as our portfolio score. What we'll want to know is for IEP, number one, what's going on with the dividend? Will it stay, right? You know, and what is up with them losing money? How long has it been going on? How long will it continue going on, right? We currently have a sell signal for waste management. So the option is either to stay where we are or potentially move into IEP. Now, real estate, we don't currently have a real estate holding. Our last real estate holding was moved into our orphan bin, so we have to purchase one of these companies. Right away, I see the dividends much larger for WPC, so that's good to see. Price action has been really good over the last 18 months or so for both of these companies, so that's good. Looks like the PE ratio much lower for WPC, yeah, much lower. So we'll need to figure out why that is and why it's so high for DLR. Now, I like DLR. I followed them quite a bit. They are in the business of leasing real estate for servers and server farms. So, you know, all the data that's being collected and all the data that is currently being held by consumers has to be stored somewhere, and DLR provides the real estate for that storage. So I think it's a really good business model and a very interesting company. But again, the PE ratio gives me some pause. All right, net profit looks like WPC is doing much better there, both on operating margins and the bottom line. Return on assets, WPC beats them out there. WPC, much more cash on hand. A lot of short interest for DLR, lots of short interest. And I have a very good feeling that that's because of the high PE ratio. Now, the PE ratio has, you know, something to do with the valuation of the company, but a lot of times it's about the feeling behind the company and the story behind the company. And just like I'm excited about DLR, others are excited about DLR, and that's what pushes the price up so high to give you those big PE ratios. And people see that, they call it overvalued, and they short it, right? That's what happens. The one benefit to having such a high short interest, however, is that if and when the company does well, a lot of times those people that are short then have to buy the stock to close their short position to keep from losing money, and that pushes the price up even higher. So it's a monster that simply feeds on itself until it can't anymore. So anyway, both of these companies are in the roughly same place as far as price action. They're very close to their 1-year highs, and looks like WPC is a bit further off its lows than DLR. I'm gonna call Alpha about the same, even though it's not. DLR much better Alpha. Of course, WPC bigger up move there. DLR got a down move. Betas are the same. DLR better average return, volatility. It's the same, which I really didn't expect. I assumed that DLR would have a much higher volatility, and I did not know this, but DLR actually scores better than WPC based on our portfolio requirements, and a lot of it has to do with the down move score, right? Because the lower the down move, the better it is. And even though WPC has a higher up move score, it also has a higher down move score. And so DLR actually beats out WPC as far as the score. And WPC has a better management score. So before making a decision on this, we definitely have to do a valuation on DLR. I'm really excited about that, to really see what's going on there with valuation and whether or not it's sustainable, right? Because if it is, then it's in a very good position to make some good money. The other thing is both of these companies are near their 1-year highs. So whatever we do, we're not going to be getting these companies cheap, okay? But understanding what these companies are and just where they are will help us make a decision. Again, as far as management goes, it looks like WPC is the better managed company. The profit margins are just better, So we'll also take a look at the cash and see what's going on there. Yeah, I'm excited about it. Technology. We're currently in TXN, Texas Instruments. We have a new member in our basket of stocks, which I'm excited about, Garmin. Great company, love the products. To have a navigation map, pretty much anywhere in the world, regardless of whether you have a cell phone signal or internet, is really a good tool. And I've always had a Garmin, take it with me when I travel, depending on where I'm going, because you never know. You can download maps, you can download topographical maps, you can download marine maps. I mean, it's awesome and it's necessary. So let's take a look at what we have here. Before I call these about the same, let's pull these out here. And yeah, so WDC, a bit higher. I would say Garmin and Texas Instruments about the same. All these companies have done fairly well, with the exception of WDC. I'm not sure why. Western Digital, they basically make hard drives. I'm really curious to add Seagate to this and kind of see what's going on with Seagate. It's one of my favorites as well. But obviously they haven't been doing so well here. PEs, I would say about the same. Garmin and Texas Instruments for sure. Western Digital is a bit higher than everyone else. Take a look now at our averages. Looks like Western Digital is under its average, which makes sense. Texas Instruments is a bit under, and Garmin is a bit over. So we'll take a look at that. Net profit, looks like Texas Instruments really just blows everyone else out of the water as far as that's concerned. And I think it's a decent comparison. Garmin and Texas Instruments. Texas Instruments does, I think, more research than Garmin does, but they are still, product companies. They do sell a product. So I'm going to call these comparable, and based on that comparison, Texas Instruments doubles their numbers. Return on assets, much better for Texas Instruments. I would think that Texas Instruments may have more assets than Garmin, but I don't know. Garmin's a global company. I don't know. We'll do a dive in that and see what's going on. So Western Digital, much more cash on hand, but it looks like Garmin has very little debt. I mean, to have a cash to debt ratio so high would mean that they have, very minimal amount of debt. So I definitely want to dive into that and double check it and make sure that's what's going on. Looks like Western Digital has a bit of short interest, which I think is almost always the case. I think, Seagate, famously has had a lot of short interest as well. But you gotta store your data somewhere. That's what they do. All right. All these companies are at the top of their channel as far as price goes. They're all close to their highs, just a bit under. Looks like Western Digital is further off their lows, and Texas Instruments and Garmin's about the same. This alpha, Texas Instruments, much better alpha. The market's doing great. Texas Instruments seems to really do well. I don't have an up move for Texas Instruments, or the number is 0. I'm gonna have to check that because that's not typical. So I have to check that and just make sure that that's correct. Down move, looks like they're really all about the same. Garmin's a little worse than the rest of these guys. Betas about the same. Average returns better for Texas Instruments. Volatility higher for Western Digital, and I'm sure that has a lot to do with the short interest. So Western Digital actually scores better than the rest of these guys as far as up and down moves. So that's interesting to see. Looks like Texas Instruments is way down on the list. So we do have a sell signal for Texas Instruments, so we'll be looking at getting out of it and getting into looks like maybe Garmin or Western Digital, but again, we'll have to really look at this and make sure that that's where we want to go, because again, if the margins are so much better for Texas Instruments, then you have to believe that the company is just being run better. And if they're being run better, then that's a company that we want to be a part of, right? At the same time, the fact that Garmin seems to have very little debt is also appealing. When you don't have a lot of debt, then you have a lot of options on your plate to get debt and to maybe buy out other companies, invest more in research. But we'll have to look into that and really see what's going on. Same thing with Western Digital. Western Digital is a decent company. I've used their products in the past. The business model, like I said, you have to store the stuff. So that's what they do. And with the short interest being where it's at, that looks appetizing, right? So that's where we are. We'll do a dive on those. Last but not least, utilities. The government regulated profit machines, the stalwarts of the stock market. Looks like they've all been doing very well in this environment. Let's take a quick look at the dividends. And yeah, just as I expected, BIP much larger than the rest of these guys. The PE ratio is a crazy number for BIP. We're currently in American Electric Power, and again, they performed really well for us, and we do have a sales signal. So we're either going to stay or sell and get into something else. And right away, looking at the dividend for BIP is exciting. The PE gives me pause though, so we definitely want to check on the valuation of the company. Looks like American Electric Power looks undervalued actually for their average, which is really cool. But I want to double check that myself as well. Same goes for BIP. Net profit, operating profit margin, these are definitely going to be the same. Now, of course, different utilities operate different parts of the country. Different parts of the country have different needs, but at the end of the day, heating and cooling is what it's about. And typically, if you don't need a lot of cooling, you need more heating. If you need less heating, you need more cooling. So I'm going to call all of these comparable. Based on these comparisons, American Electric Power does not cut the mustard. Looks like BIP wins in both categories for operating as well as net profit margins. Now, the return on assets, again, I'm calling all of these comparable. It looks like American Electric Power is doing much better on their asset management. Not quite sure what's going on with BIP. Definitely want to check into that. BIP, a lot of cash on hand. That's not typical for utility, so that gives me a bit of concern. I really want to find out what that cash is, why it's there, what they're going to do with it, and how long it'll be there. Typically for utility, you want cash put to use. You want it doing something, not just sitting around. A lot of times if cash is sitting around, well, you have to do something with it, right? And when you do something with it, it typically means risk. So there's risk of losing money. So we rather see less cash on hand than more cash on hand. However, it is really nice to know that buying a share of this company means that $4.60 of that share price is actual cash, not going anywhere. Short interest looks like it's a bit high. Again, for utility, you don't expect that. I mean, who's betting against P&W? Maybe they have some environmental issues. Maybe there's some factory blow up or something that they're having to deal with. I don't know. All these guys are about the same as far as where their prices are. Everyone is near the top. That's just where the market is right now. It's been going up, 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 up. So all these companies are near the top of their channels. Looks like everyone has come well off their lows except for P&W. Not quite sure what's going on there. Again, they may have something to do with the short interest. Alphas, we'll call that the same. The up move, much better for P&W. Down move, much better for American Electric Power. Betas, I'm going to call them about the same, even though they're not. It appears that P&W is a bit better with American Electric Power rounding out the rest. Monthly returns, pretty good. Volatility is the same. I expect to see that. P&W, outscores the rest of everyone else. which really I did not expect because of this high down number. But I guess when your up move is just so much larger than everyone else's, it makes sense. So, and then again, the management score. These guys with all that cash, kind of weird. So we'll want to dive into these as well and really find out, what's going on with P&W. It doesn't seem to be as cheap as American Electric Power to have any issues to cause a short interest. So why the short interest, I don't know. Why it's so close to its lows, I don't know. But we need to figure it out to understand what's going on. And then the PE ratio for BIP, along with all the cash, it's just weird. So we'll do a dive in on that and see what's going on. I do like the cash. I do like the dividend. So BIP looks good to me if we can rectify this PE issue. Energy. So we're currently in Exxonmobil, and the energy sector, has not done very well recently, with the exception of TRP, which is really good news. It's been performing very well. Not sure why yet, but let's take a look at it. Looks like it's not very expensive. C&Q is second up, and looks like everything is undervalued. Everything's undervalued. Looks like TRP is actually more undervalued than Exxon, though, which I can believe. But I mean, the price action on Exxon has really just been terrible. Net profit on TRP much better than the rest. Return on assets about the same. Cash about the same. Exxonmobil has a bunch of cash on hand. Not quite sure why. And again, with so much cash on hand, you'd expect the cash to debt ratio to be really high, but it's really about the same as the other guys, which means that Exxon has taken on a lot of debt. Short interest about the same. All these companies are a bit off their highs. TRP is at its peak right now, way off its lows. Alpha, I'm going to call it the same, but it appears that C&Q is actually a much better alpha than the rest of these guys. C&Q's up moves much better. Exxon's is horrible. TRP's down move is a bit better. Beta's about the same. Average return a month about the same. C&Q's volatility is a bit higher, not quite sure why. The TRP actually scores higher than everyone, and Exxon, because of the cash, has a higher M score. So what I would want to take a look at here is, again, just finding out why Exxon has the cash. And for TRP, honestly, there's not a lot here that gives me pause, honestly. I would want to just, double check the valuation, but for the most part, it looks good on the surface. So yeah, ExxonMobil, find out what the cash is there for, and then for TRP, just get an understanding of what the company is doing, and where this price is headed.